Hello everyone, welcome back. Thanks for watching. This week I decided to discuss the Sabarnes-Oxley Act and inventory controls. So we discussed Sabarnes-Oxley Act quite a bit in the financial sector, as it's a very well established federal law from 2002, but we don't talk about how it's applied often in the warehouse, specifically with inventory controls and what are inventory managers or what are warehouse managers supposed to do with this thing. How does it actually relate to them? I know a lot of them have heard about it, but let's kind of break it down a little bit and let's discuss. So the Sabarnes-Oxley Act is a federal law, as most people know, from 2002 that mandates best practices in financial record keeping and inventory reporting for corporations. Sabarnes-Oxley, or SOX, was introduced and passed by Senator Paul Sarbanes, a Democrat out of Maryland, and Representative Michael Oxley, a Republican out of Ohio, after multiple corporate accounting scandals that occurred in the late 90s and early 2000s. Most notably, as many of you probably remember, especially older people that are watching, is the Enron scandal that brought to light the depth and the seriousness of corporate malfeasance in what I estimate was largely an unregulated business environment at the time. The impacts created by Enron's corruption reverberated throughout the energy industry, ultimately costing taxpayers hundreds of millions of dollars. In 2002, the Senate Banking Committee conducted multiple hearings intended to lay the groundwork for the legislation. The hearings revealed that weak corporate governance was widespread and that conflicts of interest were commonplace among stock analysts and others in the financial sector. The realization that the Securities and Exchange Commission, or the SEC, was severely underfunded further illustrated the need for legislative action. This new legislation was to give auditors real power and enforcement across the domain that extended into inventory controls, inventory management. So it has 11 elements, most of which are related to the findings of the hearings. It gets pretty complex, but let's get some broad strokes here. Title I is the Public Accounting Oversight Board that provides for the independent oversight of public accounting firms. Title II has 9 subsections that establish the standards for auditor independence. Title III covers corporate responsibility and has 8 sections that mandate senior executive responsibility for the accuracy and completeness of financial records. Title IV covers enhanced financial disclosures, so that's good for reporting. Has 9 sections and mandates enhanced reporting requirements for financial institutions, such as off-balance sheet transactions. That was huge. So that is the one I commented there, was one that brought about a fundamental shift in auditing power. Title V, conflicts of interest, which also was rampant throughout the industry. It defines code of conduct for analysts and requires their disclosure of knowledge of conflicts of interest. So if you even have potential for conflict of interest, you are to report it. Title VI was Commission Resources and Authority. That has 4 sections and defined practices to restore investor confidence in securities analysts and defines the SEC's authority to censure or bar security professionals from practice and defines conditions under which a person can be barred from practicing. Title VII has 5 sections and mandates that the Comptroller General and SEC perform studies and report their findings periodically. That's one that's interesting. I'd like to follow up and see if it's actually being done. Title VIII has 7 sections and is referred to as the Corporate Fraud and Criminal Act of 2002. The subset act lists the criminal penalties for manipulation, alteration, or destruction of financial records while also affording protection to whistleblowers. So remember the whistleblower that came forward, the administrative assistant that came forward with the Enron scandal. I mean, that was an ugly turn of events that happened with her, and I think that one was one of the catalysts that helped bring about the Corporate Fraud and Criminal Fraud Act. That actually, one of the major subsets was to protect the whistleblowers. Title IX has 6 sections and is also referred to as the White Collar Penalty Enhancement Act of 2002. So that one basically states that white collar crimes receive higher criminal penalties and provides guidance for sentencing that may even criminalize certain actions. So you're not going to go away to a country club. Title 10 covers corporate tax returns and states that the chief executive officer should sign the company tax return. Once again, assigning personal responsibility, assigning accountability. Title 11 has 7 sections and covers corporate fraud accountability. Corporate fraud involving record tampering is classified as a criminal offense and assigns specific penalties. So the Sarbanes-Oxley Act, with bringing all these into the legal domain and giving auditors real power, has been transformational in that it has fast-tracked the implementation and enforcement of financial controls in corporate America. Financial disclosures must be accurate and reliable. They're going to be checked, and they're going to be checked again. Count on it. Obviously, financial disclosures contain data that often correspond to something physical, namely inventory. So that's where we get into what it is that inventory managers, warehouse managers need to be doing. So the fact that this all corresponds back to something physical makes managing inventory all the more important. Yet somehow inventory records are sometimes overlooked or viewed as of secondary importance. So let's give an example. Imagine if a balance sheet, which may also list assets, listed 10,000 iPads in the warehouse. Yet the warehouse only had 1,000 iPads in-house. The balance sheet was wrong. Someone added a 0 and it wasn't caught. Now, the warehouse burns down over the weekend, and on Monday, the balance sheet is used to file a claim with the adjuster, and recompense for 10,000 iPads is initiated. All of those involved have just committed fraud and may be indicted under Title 11 under the Sabarnes-Oxley Act for alleged criminal tampering. Now, that's an extreme example and highly unlikely to occur, as other checks and balances would likely flag such an obvious error. But it does demonstrate the importance of implementing solid inventory controls. Under the SOX Act, failure to maintain an accurate inventory can now have very dire consequences for those responsible, especially in cases where intentionally tampering of inventory or records is concerned, or gross negligence is occurring in some cases. Situations less severe than the scenario described can result in criminal proceedings if intent of malfeasance can be proven. So it's important for warehouse managers and inventory control specialists to have an accurate accounting for all real property, capital assets, equipment, and even consumables. It's also important to know that inventory controls are a critical part of the larger disclosure framework and must be controlled as scrupulously as our balance sheets. So that makes that floor to record and a record to floor accounting extremely important. It's the single most important aspect of inventory control to maintain, that floor to record and record to floor. This confirms, so what that is that confirms your physical count matches your virtual count, which is usually maintained in a warehouse management system, WMS, or enterprise resource planning software, ERP, such as SAP's industry-leading platform or Salesforce. This can only be confirmed by conducting annual inventories and monthly cycle counts. This cannot be pencil whipped. Cycle counts are partial inventories, 10 to 20%, conducted frequently to confirm and reconcile physical counts to virtual records. In the military, we used to call this the monthly cyclic. We usually do 10% of the cyclic inventory, and commanders were personally responsible, which was one of the reasons why I really respect a lot of the procedures and regulations in the military. I remember conducting those monthly cyclic inventories, and it was really a big deal. It took up usually 3 days out of my month to go through, but very vital. It just represented and drove home the importance of conducting these cycle counts. I really respect that time in the military, and helped me sleep better as a commander, knowing that I conducted that 10% and that the inventory did match the records, match the books, the property books. So cycle counts are different each month. They should be focused on capital assets, sensitive items, or frequently rotated consumable stock. Follow-up actions include adjusting the inventory when needed and investigating discrepancies or problems with reconciliations. Maintaining virtual and hard copy records of cycle counts is advisable. An ancillary benefit of having hard copies in hand will be directly reflected in the quality of sleep you receive each night, as I mentioned earlier. So let's talk about some best practices or inventory controls that should be implemented. Track all items by location. Okay, you've got to get your inventory organized. Ensure that they're organized in a logical system that facilitates quick and easy tracking. Standardized record keeping for inventory. One WMS and not multiple different spreadsheets. So you've got to get this in line, and you've got to get a good system. There's a lot of good off-the-shelf software systems out there. You've got to get one that works for your organization and is easy to help you maintain. Because remember, at the end of the day, you need to be able to accurately track your inventory. And if you can't find it in the system, then that's an issue. So get one that's simple. There's brilliance and simplicity, and there's a lot of good systems out there that are very simple to operate and easy to set up. Tag all inventory. Asset tags are commonplace, and we know this, but it's important to clearly identify capital assets as distinct. Capital assets are anything greater than $5,000 in estimated value. You can reference the Federal Acquisition Regulation for that. Self-audit bill of materials. So your bill of materials are records of the components of a system, and periodic audits of bombs and updates as component swaps, upgrades occur are important. The details matter. That's where you're getting down into the granular aspects of inventory management. Conduct periodic disposition reviews. So anything that's going out, your recycled items, scrap transactions, returned equipment, and even donations have got to be reconciled in the WMS or ERP to reflect the most accurate disposition status of your entire inventory. Don't forget to do this. Segregate customer-owned inventory. If applicable, in the contracting community, particularly within government contracts, there may be government-furnished property or GFP on site. The GFP must be enclosed in a separate fenced-in area with limited access. Anytime that you're holding inventory that's not yours or belongs to the customer, has already been purchased, it's got to be safeguarded appropriately. Track all equipment removed from the warehouse. So equipment that's physically leaving the warehouse for anything, whether it's a service or maybe you're not a manufacturer, but you're actually providing a service where you're renting the equipment. The equipment's got to be scanned out and represented in the WMS or ERP as off premises, and then scanned back in and updated in the system. A final report should be produced and maintained representing the entire history of equipment moves. Geo-tracking is becoming more common and should be implemented as available. So RFID tech is, it's probably close to 20 years old. It's become almost commonplace in the industry, and the prices really come down. So you should take a look at implementing RFID systems. Investigate negative balance records. If accounting indicates that there's a negative inventory on hand for a particular line item, that would indicate that a transactional flaw has occurred during the picking process. So these errors are usually flagged immediately by a good WMS, so that's why it pays to have a good WMS or ERP. And less prevalent, but very important to be mindful of. Conduct periodic obsolete inventory reviews. So one pallet of a 48 by 40 pallet occupies 13.3 square feet and costs an estimated $17 per month to maintain. Do the math and determine how many positions are occupied by obsolete equipment. It's not only a cost savings exercise, but also one of optimization and declutter. Okay, getting back into that Lean Six Sigma that we discussed in a previous video. Keeping a trim and efficient warehouse will help to better track and maintain the important inventory. So these are the minimum inventory controls that should be implemented in order to self-regulate and ensure compliance with Sabarnes-Oxley Act. There are multiple products that tie physical inventory to accounting under the ERP framework that are becoming easier and easier to navigate and manage. Even lower performing inventory management systems are now closely integrated and even pre-formatted to align with QuickBooks for smaller to medium-sized businesses. Regardless of the system being used, ensure that you are employing sound inventory controls in order to build a culture of accountability and compliance. This has been enjoyable. I went over my 15 minutes again. I've got to start to trim these videos down. But I've enjoyed discussing these topics with you, and please reach out for questions or help.